Today's conference is about the economic function of a stock exchange, and we had a very distinguished panel earlier today talk specifically about the actual exchange entities and the circumstances within this industry with which they are providing their services. Our panel here today are some of the challenges, actually, that those very same exchanges do face, competitive challenges. We have a very distinguished group of people up here with a variety of depth and background, and I'd like to take a moment just to introduce them because it's important, even though you do have their bios, to understand where they're coming from and where their background brings them. So we have Alasdair Haynes, who is the CEO of Chi-X Europe. He has extensive international management experience in both broker-dealers and in crossing systems. He has previously been the CEO of ITG International as well as ITG Europe. And he launched POSIT in Europe, which is one of the exchange competitors, back in 1998. We have Bill Hartz, who's the head of exchange traded instruments and commodities and energy at Thomson Reuters. He's known as a pioneer in algorithmic trading. Previously, he served at Shearson Lehman, Solomon Smith Barney, NASDAQ, and Bank of America. He's a board member on various exchanges, including the PSX, Market XT, Brute, Primex, Japan Cross, and Steam-based systems. Gary Stone, Director of Development and Trading Research and Strategy at Bloomberg Tradebook. He's a 10-year veteran of Tradebook, focused on creating an integrated research and execution platform across multiple asset classes. Previously, he was at Multicast Media Manager, BNP Paribas, and he served on the Federal Reserve Bank of New York. Wally Sullivan from Pulse Trading. He's the founder and managing partner. He's currently in a definitive agreement to be acquired by the State Street Bank. Launched an independent ATS called Blockcross a few years back. And he has previously worked at State Street, SG Cowen, Fidelity Capital Markets, and he serves on the board of Northern Bank and Trust. Peter Jenkins is the president of AX Trading Network. He's held head trading positions at both Scudder Stevens & Clark and later the Deutsche Bank Asset Management Group. I know him most intimately when he was leading their customer relations group at the New York Stock Exchange. Rob Howe, member of its corporate strategy group of LiquidNet. Prior to corporate strategy, he was a member of the financial planning and analysis group, intimately involved in the acquisition of the Militis Trading Group within LiquidNet, and he previously held positions at both General Electric and GE Capital. So with that, I'm going to open up the question. Gary, the U.S. national market has evolved greatly over the last decade. That evolution has been encouraged through regulation, and in some instances, you'd say some macroeconomic conditions as a result of 9/11. Are the markets better for investors today, or are the markets better for broker-dealers?
I would say just on top, yes, I think the markets are better for both. I think that the markets have undergone fundamental changes, principally towards moving from a mutual model to a for-profit model, and that has benefited both investors as well as the broker-dealers. I think the competition has caused exchanges to become more responsive to client needs. They are focusing on different constituencies and trying to create different models to fill those constituency needs. Probably the Philadelphia Stock Exchange is a good example of trying to, through the size price time priority, providing something for institutions who are trying to trade larger sizes by giving them priority. You also have algos with BATS's pricing, which enable the broker-dealers who are takers in their algos to receive reduced costs, and I think that's helped a lot. If you take out a lot of the noise that's going on with the high-frequency guys and just look at, in general, what's happened, I think what you'd see is that if you look at Elkins McSherry, you would see that transaction costs since before Reg NMS to now have dropped around 25%. And so that's a big drop in transaction costs in the total order. And even though there are a lot of issues with chopping up orders and making them smaller and taking large orders and flow through the marketplace as smaller orders and trying to deal with that, I think in general it is actually benefited. In terms of high frequency, there are a lot of issues with it. I'll talk about that in just a quick second. But in general, I think what you'll find is that spreads have narrowed since 2006, and even in the high volatility periods in large cap stocks where high frequency traders tend to be very active, spreads have come in and they've stayed in 2008 when we had the ban on short selling and basically taking the high frequency guys out. There are several studies that show that spreads widened dramatically and the depth of the NBBO collapsed. So I think that they added a lot of liquidity. If you go into the small and mid-cap space, I would argue that there have been mixed results with it, depending upon volatility. Spreads, generally, if it's very volatile, spreads haven't been there. But everything's not really rosy. I think we have a real market structure regulatory issue that at some point in time the SEC and the industry is going to have to deal with. There are a lot of conflicts that are going on, and just to give you one of them, we talk a lot about high-frequency players. We talk a lot about what happened with the flash crash. Yet we put circuit breakers in to deal with it, but it doesn't deal with the overall problem of the marketplace, which is that Reg NMS requires fair access, and you have for-profit exchanges which are dependent upon high-frequency players for not only liquidity, but also colo and other types of fees. The problem is that we've created a structure where we have two competing forces that are coming in, and so an exchange, which does have a self-regulatory body, does not have the power because of Reg NMS's fair access rule to actually turn off people who are behaving incorrectly, in that I'll say that they have high message to cancellation rates. Okay, so the exchange can't really protect the integrity of its marketplace and shut people off who are doing things to create latency skews. And I think those are the types of things that at some point in time we're going to have to address. And that's probably the downside of what we have exhibited in the market structure today.
Anybody want to add anything?
Hello. I would just add to that. I agree with a lot of the statements. I think the market's evolving since Reg NMS has been put in place. I would say though that the institutional community, although the transaction cost analysis saying in general that their costs are coming down, I would say that, or I would guess that if you separated out the small cap, micro cap area, that's probably gone up dramatically. I've seen some studies that may indicate this. So I think for the small cap, tough to trade situations, the environment has gotten a little bit more difficult, and this is where the alternative trading systems really do come in and play a role in the marketplace.
Can I just give a perspective of Europe here? The great thing of seeing competition in Europe is that in 15 markets where we compete, there's one, and I apologize now if there's anybody who's Spanish in the audience because I'm about to be rude about your country. But there's one country that has failed to comply with MiFID, which is Spain. And there's some very interesting studies on this. There's one by a professor at the Goethe Institute called Peter Gomba, who's shown that where you have competition amongst all 14 other markets within the EU, you've seen spreads narrow, liquidity improve, and exchange prices drop dramatically. So in effect, every single person, whether it's the broker-dealer or the end user, is benefiting. There is one market, however, where actually the prices have risen, spreads have remained the same, and liquidity hasn't improved. And I think there's no greater example there that if you don't have competition in a market, you don't create the true competition that drives prices and drives innovation. And I think we've got it in Europe. That will change. Spain will be forced to change. But I think it's a great example of what you've seen not just happen here in this country, but what you're seeing happen around the world now.
Thank you. Thank you. Bill, the clarity of lines differentiating between an exchange and a broker-dealer have lessened over time. What has precipitated that, and where do we see that heading?
Thanks, Joe. It's as I think about the competition between brokers and exchanges and listening to particularly three good friends of mine who spoke earlier, Gary Katz and Albert Berkeley and Brett Redfern, each of them expressing slightly different takes on, what's good for the markets and what's not good for the markets and so on. I think it sort of just brings you back to this belief that where you stand sort of depends on where you sit. The brokers have always thought about competition from exchanges. The only thing was that throughout history, exchanges were member-owned, and there were always checks and balances on that competition. And I think once exchanges demutualized, brokers sort of became more concerned about it. One result of that concern that we see today is are all these various forms of internalization, like dark pools and so on. And I'd like to touch on sort of one place that really sort of points up, I think, a lot of where the competition is heading, something that we're actually working on at Thomson Reuters, along with some other people, which is sponsored access. And to me, sponsored access, obviously it's again on people's minds. The SEC has been promulgating some rules on it and so on. And I remember not so long ago being approached by a large hedge fund client of the bank that I worked for, and the client wanted a direct connection to the exchange. And we were sort of concerned about it because it wasn't you. Anyway, we were concerned about it for a bunch of reasons, but we wanted to accommodate a large client who really wanted this direct connectivity. So we sort of hit on the idea of going to our lawyer, and the conversation went something like, listen, this client really wants to do this, and can we do it? Well, actually, please tell us we can't do it. and of course, being a good lawyer, they'll always tell you that you can't do something. So we went back to the client and said, listen, we'd really like to let you have this direct access to the exchange, but our lawyer just tells us we can't let you do it. I just sort of wanted to point out, what were we worried about? Well, first of all, and all these things I think are as true today as they were back then. The first one was, and most important really, was the inability of our trading desk to interact with that order flow. When flow goes directly to an exchange, the broker essentially loses the ability to trade with it. The second one was to protect ourselves, our bank, and our client, by the way, from things like fat finger risk and programmatic errors. As Joe Rosen pointed out before, just because you can do something doesn't mean you should, or that it's even in your best interest. And the third was that we were worried about competition from exchanges. And we really worried about the idea that with a flick of a switch, that we could be completely removed from the client relationship altogether, completely disintermediated. And so I think today, the SEC has basically chosen to remove some of these barriers, replace them with some others. I'll leave it up to Steve Wunsch to figure out what the unintended consequences of that'll be. But I think it will become an important front in this area of competition between exchanges and brokers.
Thank you. Anybody want to add anything? Rob, does exchange consolidation address the needs of institutions? A lot of publicity, but few deals have actually closed. What does it all mean?
I think, first, thanks for having us. The short answer is no, it doesn't address the needs of exchanges. At Liquidnet, we have a unique perspective on the exchange space based on our customer base, which are the largest asset managers in the world. And we feel that consolidation doesn't really address the needs of these institutions, our customer base. And if you look historically, exchanges have not really addressed the needs of the buy-side institutions. We heard earlier what exchanges are focused on these days: data products, derivatives, even catering to high-frequency traders. So the one constituent that's left out of there are the large, long-only asset managers. And at Liquidnet, we're working with the exchanges to try to address those needs. One example is a recent announcement we made with the Swiss Stock Exchange that allows Swiss's customers to send large blocks safely into Liquidnet's liquidity pool. And this helps the Swiss customers, it helps Liquidnet's customers. It really combines the best of both of our worlds. If you think about the wholesale marketplace of Liquidnet and a retail marketplace of an exchange, you're really combining both of those. It also it helps with exchanges going global. We're going to allow the Swiss Stock Exchange to trade in 5 additional markets. And we also feel that it could benefit the country as a whole as efficiency comes to the capital formation process, more investment dollars can flow into the country.
Thanks, Rob. Peter, how has the domination of high-frequency trading on exchanges affected the institutional investor? Does HFT, as the new market maker, satisfy the needs of those institutional traders?
Again, I would talk about different stocks or classes of stocks trade differently than others. I think what has happened over the past or since Reg NMS, I would say that for a small group of securities, stocks, that the high-frequency community has really developed a lot of liquidity. I'm not too sure just because the spread has tightened that necessarily means that that is the right price. I mean, because these things are bouncing around a specific price. But I do think that they have added liquidity. They have become the market makers in the new environment. The specialist, to a certain degree, or the old specialist is now more of an electronic market maker. Has it helped the small cap and micro cap or a very large situation? No. And I think those type of situations are avoiding exchanges and going to the broker-dealer and trying to get the broker-dealer to find the natural other side. There's certain situations where, and going back to my buy-side days, you would rather deal with another natural counterparty. You really do not necessarily need a market maker putting up capital, even in the smallest amount. So, I do think that for part of the market, it looks real good, and the costs have come down. I agree. But there is still that one, there are areas of the marketplace that need a little bit of help and a little bit more development, and I think you are seeing that in the ATS world. And if the ATS world fills that void, fine. And if they can mesh together in an electronic world, they should be able to work together.
And I find it interesting, just to throw my 2 cents into it. Back in my days on the New York Stock Exchange floor, the biggest complaint from most of my customers, and some of you that are in the room right here today could probably remember some of those conversations, finding liquidity in those small cap, mid cap stocks that were even listed on the floor of the exchange. It was challenging for then a market maker to publicly display what they would want to buy and sell in a stock that doesn't trade very frequently, because that loss of information, even by making that bidder offer, adversely affect the pricing mechanism that was taking place in a public format. So I agree with you, Peter, in a lot of ways that we're still searching for solutions to problems that have pretty much always existed. Old exchange style, new exchange style. It's an evolution, and that's what, thank you again, Bob, for putting conferences like this together so we can get people to talk about these things publicly. Alistair, not talking about high-frequency trading specifically, but what does size and speed mean to the markets today? How does that affect trading?
Well, size and speed are important, but not in the way that I think most people think. There was an interesting discussion in the earlier panel talking about speed. Is there a race? Each exchange is going to compete and get faster and faster and faster. Well, I think somebody mentioned earlier on, it was like blinking. You're all going to blink. Well, I'm not going to ask you to do that, but I bet you don't know this amazing fact, which is the dung-loving fungus is actually the fastest thing on this planet. Now, not many people have heard of the dung-loving fungus and the spore that is emitted from it. You may know that the sparrowhawk, I think, is the fastest bird, which reaches terminal velocity when it's actually catching its prey, or the leopard is the fastest mammal, which really you think is completely and utterly irrelevant, which is why speed really becomes quite irrelevant when it comes down to the nanoseconds, picoseconds, zeptoseconds, femtoseconds, or whatever you want to wish to talk about. The key thing about speed is, look at the human. We sit on the top of the food chain, and we're pretty slow. and looking at some of you around here, I'm pretty slow. But the truth is, we're well configured. That's what an exchange is about when it comes to speed. It's not about how fast you necessarily are. It's how well configured to get all the information. People talk about this information and, the number of quotes and the number of, fills versus quotes. It is ridiculous long term to think regulators are going to try and police that, because it's impossible. It's great rhetoric, wins votes with politicians, but just impractical. What you need to do is build exchanges that have that capacity. The technology is here. Moore's law shows the technology is here. You're going to get faster and quicker and more efficient, but you're going to get more trades down a pipe, not necessarily just to be the fastest. We've become the largest exchange in Europe by volume, by value, and actually, we're not the fastest exchange. And we're about to become, and sure enough, in 9 months' time, somebody else is going to become faster, and it's just going to leapfrog. As long as you're in that zone, you can compete. So speed is one thing. The other thing is size. Size is important, not because you have to be big. Remember the dinosaurs, they were pretty big, they didn't last. Size is important because you actually need to be small. You need to be efficient. You need to be effective. The reason we can eat the lunch of the nice national exchanges that are around there is because we are just so much smaller. There's 47 staff in Chi-X Europe. That actually is slightly less than the catering departments of all the national exchanges in Europe. So, yes, size is important here, but not, again, for the reason of being big. Be big by the amount of business you do, not, and be scalable, but not in the size that you actually operate.
I'd like to just point out, a lot of people have talked about how markets are more efficient because of electronic trading, and to some extent they are. I think if you look at spreads and things like that, there are a number of studies that will tell you that they are. But I think it's important that we remember that all this electronic trading has also saddled us collectively as an industry with hundreds of millions of dollars, if not billions of dollars, of infrastructure cost that we've had that we continue to spend on year after year in order to cope with the increased number of quotes and the communication line. You can go on and on, servers, and so I think that tends to get lost sometimes when people think about efficiency of markets, but it's something we really need to be thinking about.
Well, I'd also add to that, I think there has to be a certain amount of fairness as well. One of the things that happens is that all that infrastructure in such a way that everyone receives market data equally, and therefore your position of proximity, perhaps like where you are on the court next to the matching engine, because you have the ability to be able to buy your way into that, shouldn't necessarily give you the ability to get an unfair advantage vis-a-vis someone who's an institution or someone who's serving an institution trying to access that matching engine.
And we would wholeheartedly agree with that. I mean, equality in exchange is a very important thing. And I think it is extremely important. However, it's slightly Orwellian. All men are equal, some are more equal than others. It's you've got to also think that latency is only important to a handful, a small number of people out there. When you're dealing in those microseconds, most people, and it is a random walk, therefore most people don't necessarily need to be the first one there. And people, you've got to weigh up the pros and cons of what you want to do here. To the average retail investor, they don't care if they're trading in microseconds. They don't necessarily, there's this lovely thing about uninformed flow. The uninformed flow, I found historically, tends to be pretty well informed. So I don't think you necessarily have to be building an exchange which allows 500 different members of it to be co-located or have proximity solutions that are equal. What you do have to do is allow that exchange that anybody who wants to be should be allowed to be. That's the important part. That's where you get equality.
Wally, I'm going to bring up a concept from the SEC's concept release in 2010 called Trade At. And for those who are in the audience, I'll give a brief description of what Trade At was offered up to the industry for discussion. Basically, effectively requiring any matching or trading engine to utilize the transparent markets bid and offer for effectively pricing any trades in the marketplace. Or a variance of that would be to have a minimum increment off of that transparent best bid and offer as a means by which to price business, whether it be on an exchange or off an exchange in an ATS. So while the majority of the industry responses on that particular question were not in favor of implementing it in the marketplace, the term and concept continues to surface in the press, and the discussion amongst regulators, it relatively comes up every other sentence. What are your thoughts on the impact of the exchange structure if the SEC actually does put out a new rule filing?
Well, thanks. It's an interesting topic to discuss. You know, if part of it is that, you know, the broker that perhaps is running an internalization model, which I think this rule is really trying to target, would have to give, even if it's a half a cent price improvement, would have a significant negative impact on the high-frequency players because their models just wouldn't work, in turn negatively affecting the internalization models because their cross rates aren't going to be as high, and essentially a lot more of that flow would be routed to exchanges. You know, again, it's an interesting discussion to debate. I personally just think that it'll never happen. If you put yourself, you know, put yourself in that regulator's shoes and say, do you want to be that regulator who pushes through trade at rule and equity volumes the next day get cut in half? You know, I personally think that, you know, there's a lot of concern about high-frequency guys. I agree that, you know, they certainly have their place. They are the new market makers. I personally think, though, that the pendulum has swung too far in that, you know, they're such a dominant position because so much of even the institutional flow just gets defaulted into DMA algos that slice everything up into 100-share lots, and that's essentially what feeds the high-frequency crowd. You know, you know, if you talk to these guys, they don't make money just trading amongst themselves. They have to feed off the retail in the high frequency. Now, I personally, you know, we operate a system that is not an internalization model. It uses blotter integration, so it's further upstream. It reads the buy-side blotters, and like a LiquidNet, it matches up natural block liquidity further upstream before it reaches an exchange. You know, what I would say is I don't think high-frequency guys will be brought in line using regulation. I think the natural competitive counterbalance to them is essentially improving the efficiency of the upstream technology to match up more of the natural liquidity. And it's happening. There are some things happening behind the scenes that are already taking effect and I think will continue to take effect. On the sell side of the equation, you know, the broker algos now are introducing contingent algos, which essentially allow you to work in the marketplace while simultaneously searching for blocks. What's new in the industry now is that those algos, they're allowing the blotter integration systems to actually read the contingent portion of those algos. Blotter integration technologies, they're just casting a much wider net. The other one is some of these dark pools, meaning there's only a handful of dark pools in this country that trade blocks, 5,000 shares and above, right? A lot of these happen also to use this blotter integration technology. Some of these dark pools, what they're starting to do is link the dark pools using binding indications. You know, you give your client the option on whether or not they want that service, and almost all of them will opt in globally when they understand how it works. On the buy side of the equation, there's now possible uncommitted exposure to all the algo traffic. So all three of those are basically new innovations which are essentially increasing the duration. And it's solving the fundamental problem in the ATS space, meaning the upstream block liquidity, where it's solving the problem of ships passing in the night. Because right now, if you look at how much block or chunky block liquidity is in these algos, you know, it's staggering. It's billions of shares of actionable block liquidity a day. So The problem is not necessarily it's the desire to trade blocks. It's just that the way the space evolved, it's no one's in that right pool at the right moment. Well, that is actually currently being solved. So, I think that the industry is healing itself. It's using new innovation techniques which will counterbalance these high-frequency guys because, for every 10,000 share block print, that's 20,000 shares that don't feed the high-frequency guy. And I think basically what you probably see is instead of 60, 70% of dominated by high-frequency guys, I wouldn't be surprised if, shortly down the road, that drops to maybe 40 or 50, and you'll see the institutional volumes trading in higher print size and perhaps, bringing more influence into the marketplace.
So you're predicting bigger block prints and a greater percentage of the tape somewhere down the road?
I'm presenting a,
Because we got a lot of customers out here that are thanking you very much right now.
well, I wouldn't say, not necessarily large block trading making a huge comeback, but I think what you'll see is a resurgence of medium-sized prints. If there's some stats that show the high-frequency guys can't play when you start dealing in print sizes above 700 shares. Well, if the institutional community improves the efficiency of matching up natural liquidity, that will act as a natural counterbalance because you'll stop feeding the high-frequency guys.
Well, I'll agree with you, but the VIX has to get below 30 to happen.
Yeah, could be right.
I think let's be clear, trade ad, if it is implemented, will result in much more volume being printed on exchanges, being executed on exchanges. And I think that all the different forms of internalization, whether it's blotter scraping systems or dark pools or all these upstream internalization mechanisms, will suffer if it is implemented. And yet, from an exchange's standpoint, you really have to be sort of sympathetic. They don't want to be the liquidity pool of last resort. They want to be the liquidity pool of first, where you go first. And a lot of the upstream marketplaces or market centers effectively circumvent that. So I think that's really what trade ad is about, and it'll be interesting to see if it really does have legs.
Well, I think it's a concept that, and as you know, will drive flow to the floors or to the exchange centers for printing. I do wonder, though, all of these products that have been created and all of the ones that are being talked about and being built to satisfy the needs of investors today, especially institutional investors, whether a regulation will try to obliterate those solutions that have been put in place. Transparency or opaque strategies for investors has always been an integral part of the investment process. And I'm not here to preach a sermon, but it is what it is. What I did for 25 years. That solution has come to pass in different other technological solutions, many of which are sitting right here on this dais here. So trade ad is a big discussion point. It is something that the academics do need to weigh in really very, very arduously. If it does come out, I believe it will. I do think there's another discussion coming. It just doesn't want to go away. Every time I'm in Washington, and I'm in Washington twice a month, it comes up. And it doesn't want to come up in our industry, but it does come up down there, and they do guide us. So I give everyone pause, and I give everyone caution on that subject. Peter, have institutional brokers become more or less aligned with exchanges?
I would say that they have become more aligned with the exchanges in a certain portion of their volume. Algorithmic flow is obviously a much larger portion of their business than ever before. But then again, and this has not changed over the years, internalization and trying to match up customers and really satisfy their best execution obligations at times forces brokers to match up customers and not if they do not think it's the right place to go to an exchange, especially in an environment where we have this high-frequency issue. So they're kind of not aligned with the exchange, but they are. A greater amount of their volume is done algorithmically, so they're very aligned with the exchange. But there still is that portion of their business where they're trying to cross it upstairs and satisfy that best execution obligation for the institution. So it's probably the same as it was. Nothing has changed there.
Joe, we've been very equity-centric. So one of the things that the options exchanges have actually done a very good job of is bringing the institutional brokers in. And probably the best example of that would be the spread books. So a lot of institutional investors don't want leg risk in their different spreads. So if they're doing a volatility trade, I do a stock with an option. And one of the things that the options exchange has done a very good job is creating spread books where it's a package. You don't have leg risk, and it either happens or it doesn't. And so I think that there are certain instances where that has occurred. In other marketplaces, I think the equity market is, and one of the things that the gentleman from the Deutsche Börse was talking about is that as the exchanges consolidate, you may see more of this consolidation in different asset classes, which then causes the innovation that we're looking for the institutions to be able to do the strategies that they're looking for without necessarily leg risk or anything like that. And so I think that just to comment on that, just to point it out that the options exchange has done a pretty good job of that.
So the consolidation has a benefit in that perspective.
To some extent, not when you're
I do think
90% of the
risk is a
market.
big part of what makes our markets competitive, though.
Yeah.
I don't like taking risk out of it. Yes, did you want to answer?
Well, it depends where the risk is, though.
Rob, what do they need to do to remain viable today? I mean, you're a competitor.
Yeah, no,
What do you see on that front?
it's a good question. I can only comment from an equity perspective, and I think, we saw it with the Deutsche Börse presentation, that equity trading is really a smaller part of the exchange's revenue base now. I looked this up the other day. The NYSE and the NASDAQ, both equity trading is less than 20% of their revenue now. So really, they're focused on other products, and to remain viable, I think they gets back to a point I made earlier, is they really need to focus on their core customer bases on the equity side, and that's really corporate issuers and the buy-side trading institutions. So they need to innovate there, they need to bring new products and services, and they have to be global. So.
Anybody else?
Yeah, can I jump in there? I mean, you're absolutely right, 20% for NYSE and NASDAQ, but what is important in an exchange is building market share. Because, and this is a very contentious issue in Europe, market data here is something in the region of 7 to 9 times cheaper than that in Europe. Clearing is something in the region of around about 7 to 10 times cheaper here than it is in Europe. And yet, if you look at the profits that are made by exchanges out of data and clearing alone, and people like us have eaten the lunch from the exchange fees, which have clearly fallen. But to tell you, I mean, London makes £193 million a year out of data services. Euronext makes something in the region of 200 million euros a year. Deutsche Börse are about 190 odd million, NASDAQ about 70 million. These are not small numbers. This is an 800 million euro business in Europe. And that's because it's 10 times more, or somewhere between 7, 9, 10 times more expensive than here. Competition can drive that down. And that's exactly what has to happen. So exchanges do have to look at the models because it's too easy for a national exchange. And what worried me with Mr. Francione's speech was the talk about we go vertical. Vertical integration and vertical is the same thing. You still own it. Therefore, you can control it. And you're right. You can do every product if I have a monopoly. But does the world really want to see a monopoly? We want to see monopolies broken here to see competition, and you don't get competition in vertical silos.
I think that exchanges, I mean, if they really want to be successful, they need to start, or to remember to focus on their biggest customers. I would say, rather than the smaller, high frequency, or I should say, low latency trading firms that are really looking to maybe arbitrage market data fees or exchange fees or so on, rebates and so on. I think that type of activity, while it appears to pump up the volume of markets, in fact, it doesn't really do much to help their biggest customers. So I would focus on that.
Yeah, there's four things an exchange needs to survive or to be or to have, to be in existence. One is a strategy which has a clear goal for growth. If you don't have that, you're not going to succeed. And I worry that some of the some exchanges around the world have a sort of right to be there rather than a strategy of how they're going to be there. You have to build market share. You can have the most innovative, creative, brilliant system out there, but if you don't build market share, you're never going to survive because you can't sell data, you can't do all the other products that you need around it. You have to have sustainability, and that's one of the things that we as Chi-X did. We became profitable 2 years ago, and most people, when I certainly started there, said, oh, don't worry about these guys, they're all going bust, they never make any money, they're never going to be around. Well, once you become profitable, you're sustainable, you can grow the business, and that is key. And then the final point is the one that most people laugh at me when I talk about it, is social responsibility or social utility. There is a reason for an exchange to be here, and there's a social reason for the greater good to be able to drive prices down. And you can never forget, we don't list stocks, but if we grow the depth of liquidity in a marketplace, you're actually going to lower the cost of capital for the whole purpose what exchanges are here for, which is for companies to issue. And if a company issues and it lowers the cost of capital, we've done something for the greater good and to help the economy. So that's what competition really does. And those four things are essential in any strategy of an exchange.
Well, the discussion around market data and the costs of processing that data are probably on the cusp of becoming one of the bigger open topics of discussion. Some of the comments that were made earlier here in this conference, some of the things that I've been reading about, and some of the discussions I've had down in Washington, lead you to believe that from a consolidator standpoint, and that means anyone sitting up here or anyone servicing any customer needs to process the market data in an efficient and effective manner. And where and how they get that market data is a point that's up for discussion, and whether it should be regulated, whether the price should be overseen. But it is a big part of what the future of exchange survival is, and so there's a battle back and forth, so that's something for the future. But I'm going to open up one last question, because then we're going to open it up to the audience, and I think it's a great question. What does the exchange space look like in 2020? Alistair, you want to start it up?
Okay, the great thing about this is I couldn't tell you what it's going to look like in a couple of weeks, because that's an impossible question to answer. But in 2020, I've got 9 years, and you won't track me down to find out if I was wrong or right. But I think actually it's not that hard to look at what exchange is going to be like, because there has to be consolidation. They are going to be more global. And one of the reasons of success of Chi-X in Europe has been prior to us, the customers, the end customers, look at Europe as one economic region. They invest as one economic region, whether there's a euro or not a euro. The investment banks are set up by having America's region, a European region, and yet the irony of it is, when you actually come to the place where you trade, they're all national, and they have been national. So there's no doubt in my mind, just as the internet has changed the way people shop from being local to global, then equity trading is moving from being local to global. Now, that period of time, I can't tell you what it's going to be. Maybe by 2020, I don't know. But it's moving in that direction. The other thing is you're going to have two types of players in there. The 4 or 5 players who survive will be of two types. And the analogy here is the airline industry. In exactly the same way you have national incumbent airlines that have now merged or joined together in alliances like Star Alliance or One World. They serve a purpose in the market. But you're also going to get people like us who are the low-cost budget airline. And we also serve a very important part in that marketplace. And the mistake that Lord King made as chief executive of British Airways is he assumed that you, the business community, would always want to sit in a lounge and be comfortable and always travel on British Airways. But actually, if you want to fly, you want to travel safely, the fastest way and the cheapest way. And the reason why this analogy, I think, is good is because when you get on an aeroplane, whether it's with JetBlue or whether it's with American Airlines or whether it's with Ryanair or EasyJet or whoever, The Civil Aviation Authority makes certain that that plane is safe for you to get on. In exactly the same way as we have to have good regulation that makes it absolutely safe for every platform that you trade on. So regulation is key, but you're going to end up with two types of platforms, and the economics is simply there. You can't have 50 players trying to play in this game. The pricing levels and what's going to happen with the price pressure is going to allow only 4 or 5 people to survive in this. So there'll be a war of attrition and different styles of business, and the game really has only just started.
Anyone else want to take a stab at that?
I think that if history has shown us one thing in this business, it's that the exchange consolidation and fragmentation are cyclical, and whether it runs every 3 years or 5 years or 7 years, so what Alistair just said is absolutely right. However, I think following that consolidation, you will see yet another fragmentation. So the short answer is in 2020, I think we're probably just as likely to look exactly as we do today as anything else.
I'm going to say clearing. Whatever happens in the clearing space is going to drive the exchange space. I'm going to throw something out there. Just imagine a world right now where we have Dodd-Frank, where you're going to have fragmented swap execution facilities. They're all going to be competing, and you can choose the clearing counterparty of your choice. Imagine what happens to the futures market if Dodd-Frank basically goes into the futures market and you can actually clear anything you want into the CME's clearinghouse. That would fragment and take away transactions from the clearing space, which could just disrupt the entire exchange system. If we're going to go global, you have to have the ability to be able to take the stock that you traded 24 hours in Germany and bring it back to the States, because that's where your custodial bank is, and do it in a cost-efficient way. If that occurs, you're going to have amazing competition within the exchange space, but it's being driven by what's going on the clearing side and the flexibility it affords.
Good point.
I think we'll see in 2012, or in the future, efficiencies on two fronts around trading. One is ideas. I think we'll see that the best idea or the best investment is not necessarily what's in your backyard anymore. It's going to be the U.S. portfolio manager looking for that healthcare stock in Thailand or Indonesia. So we're going to see a flow of investment ideas around the world. The second is around trading and efficiency. I think we'll continue to see the barriers to trading coming down. We'll see that liquidity will seamlessly flow around the globe, and that the trading will be more efficient because there'll be two marketplaces. There'll be a wholesale marketplace for size, and there'll be a more retail marketplace for the smaller executions that we see on the exchanges.
I would just add to that. I think one thing that does not change is there is a role for a dealer using their capital. I just think that we swing from bigger use of it to when you get more efficiencies, you're matching up those natural buyers and sellers. And the craziest thing is the market has become, or with technology, it has become more efficient to trade with each other. But if the numbers are right and the high-frequency proprietary traders are 50, 60% of the volume, we're using a lot. There's a lot of capital, proprietary capital, being used to match buyers and sellers. And so I think there will be a trend back to people will think up products to get the natural buyers and sellers together.
Thanks. With that, I think we'll open it up for questions from the audience.